Casey Orange, sir. Good evening, folks. Yes, our first question for the evening. Thank you very much, Jane. She says, I want to invest some money. What's best? Jane, there's so many options and it's very difficult to tell somebody what is the best option unless we understand what your needs are. So if you want to invest for retirement and you don't have a pension fund or retirement annuity, or you're not contributing the maximum to it in order to get tax rebates, then that's always a very good option to start there. Tax-free investments, that seems to be the flavor of the month. Everybody wants to do a tax-free investment. That's a very good investment option if you want to get tax-free returns. Then, of course, there's endowments and there is unit trusts. That could be very good for you. All of these decisions depends on what your personal circumstances are. The only way to determine what is the best investment for a specific person is to understand what your needs are. So that takes into consideration what your income is, because your income is a pretty good determination whether a retirement annuity is going to be to your benefit or not. Assets and liabilities. Sometimes the best investment is to actually go and pay off your debt. As much as people don't understand that, that might be the best investment that you can do. So where you are in life, how old you are, and how long you have to invest, etc., etc. So there's really a lot of different things that is a determining factor for me as a financial advisor as to what would be the best investment for a specific person. Now, sometimes you will find with investments that retirement and annuity and a tax-free is basically 50-50 as to which one will be best. Or an endowment and unit trust, very close to each other. So there's no hard and fast rules. But it is always best to have a financial planning session in order to determine what would be the best product. If you do not have such a session, to me, the most important thing is that you start investing. I mean, as much as I'm not a big fan of bank savings accounts, even if you just start saving money in the bank, it's better than nothing. So it might not be the best possible investment, but it's better than nothing. So just start. That is the most important thing, is just start with investments. Any investment you start with today, okay, is not going to have a major impact 6 or 12 months down the line. So even if you just start investing today and you only get a consultation, or you speak to somebody, or you do your own research over the next month or 2 months or 3 months until you decide which is actually the best, at least you started. That is the most important thing. What is the biggest TFSA balance you've ever seen for an individual? You know, that's actually the scary part. They're very small. Most people invest and they withdraw every couple of years. People seem to think, wow, I've scored big time because I'm investing there. And then after a year, they take the money and they go blown on a holiday, or they go and buy a TV. And people that do that, oh man, they absolutely waste their time. Biggest tax-free investment I've seen up until now, most probably about 350,000. It should have been substantially more. People that actually started tax-free investments when they were launched could well be almost at the maximum at the moment in terms of their contributions. But yeah, I really haven't seen big tax-free investments. And again, it comes down to the same thing. People either started later in life, or people keep on withdrawing the funds. It's such oh man, what's the word? I almost want to say, it's so sad. I almost want to say it's so sad that people want advice and they want to invest money and they want to get all this tax-free returns, and then they go and blow the money and they never actually get the benefit of the tax-free investment. There you go, Fayad. I hope that gave you a bit of background. Let's see who is next in line here. Next in line is MK. Hi, I'm 60. I work for government 42 years. Basic salary currently 71 per month. How much will I get if I take early retirement? So MK, I can't tell you how much you're going to get, mate, because remember, in government, depending on which department you're with, Retirement age can be anything from the age of 60 to 65. Now, if you are 60 and you were in the police force or warden in jails or something like that, then you would be at retirement age and you won't lose out. If you've got another 3 years to go or 2 years to go, then it might not be that much. You can basically work on the principle of every year that you retire before your actual retirement age out of the GPF, your income will be 4% less than what it would have been if you took normal retirement. So basically that is what you lose out. That's the reduction. So every year earlier, so on 71,000, work out what is 4%. If your retirement age would have been next year at 71,000 and you retire now, you will get 4% less than 71. If it's 2 years down the line, 8% less. 3 years, 12%. Up to 5 years, 20% less. So let's say you are 5 years on 71,000 Rand. That means 14,200 Rand of the 71,000. That will be the salary you get, about 20% less. It's not a hard and fast rule. It's the basic rule, because remember, these days there's the gratuity offer on the table, which can be and has to be approved, etc., etc. But 4% is a very good percentage to work on to get a good idea of how much less you will start off with. Jane says, I'm retired, no debt, I want to save, I'm only 58. Oh, okay, Jane. If you are 58 and you only want to save, once again, Jane, now it comes down to how much are you earning? Because if you're earning in your retirement enough to basically be above a tax rate of 30%, then an endowment will be a good option, although you're going to have to wait at least 5 years. You're going to have to invest at least until the age of 63 or longer. If your retirement income is such that your tax rate is less than 30%, well, then a unit trust might be a good idea. And then again, Jane, since we are on the subject, whether it's now going to be from a tax perspective, a unit trust or endowment, it very much depends on the underlying portfolio that you invest in. So if you go to Old Mutual, for example, and you can choose to either take an endowment or unit trust, and inside of that unit trust or endowment, you have to choose which unit trust, which portfolio you're going to take. And if you choose a portfolio that is an equity portfolio, you can expect to get 10%, 12%, maybe even a higher return. But you can also choose to go and pick a stable fund, and then you're going to be lucky to get 8%. So the underlying portfolio together with the product will determine what is a good investment for you. Even though you are in retirement, even a retirement annuity is a possibility, because you can still get tax rebates on the premiums if you can use it. V. Bethel, if I invest 1.4 million, how much can I get every month? Where's my calculator? So I actually have answered this question a number of occasions for different people, and it is virtually impossible to tell you what the income will be. So what I can tell you is the income will be between 2,916 Rand per month, 2,960, and 20,416 Rand per month. Now, why is the income between those two extremes? Because if you invested in something similar to a living annuity, you can take anything between 2.5% and 17.5% as an income. Now, here's the difficult part. If you do take 17.5%, your income will actually start reducing in the future, and your capital will be exhausted in a question of, I'd say, about 10 to 14 years. Because you're taking too high income. But you can take that income. That's the point. You can take that income, but it will eradicate your capital that you've got. If you take 2.5%, your income will actually increase every year, because the growth you're going to get will increase capital, so you will get more and more on a yearly basis. And then If we go and we look at not something like a living annuity where you choose the income, if you choose a guaranteed income, then there's a number of factors once again. You have to choose a guaranteed term. You have to choose by how much it increases. You have to choose if it's a single life or a joint life. And then every week the annuity rates changes. So once those factors has been taken into consideration, the income can again differ from very little to very much. So there is no hard and fast rule. It all depends on what type of product you're going to take and what your need is. So again, it's a planning exercise. What I can tell you is a safe income to make sure that your capital loss for the rest of your life would be about 4, maximum 5%. So if you go and calculate what 5% is of 1.4 million, that's about a good average income you can take while not exhausting your capital, not eradicating your capital. Pati, is it late to start an annuity at the age of 46? Pati, it's never late to start any type of investment. And if the retirement annuity is going to give you the benefits of the tax rebates, so help you in terms of your tax returns on a yearly basis, then no, it's definitely not too late to start with that. So it all comes back to the pension and provident fund and retirement annuities that you have. How much are you contributing at the moment? Therefore, can you still invest more in order to get further tax rebates? So no, it's definitely not too late to start with it. Just again, you have to go and determine, you have to go and work out whether the retirement annuity is going to be the best type of investment for you. And for that, speak to a decent financial advisor, okay? Okay, folks, now it's going to jump again. Fayyad says no, better late than never. I agree with you. I agree with you. Let's see, who have I skipped here? My Gigi says, good evening all. And Sanam says, I like him. Who do you like, Sanam? Yes, reg meneer. Oh, thank you. Is it me you're talking about? Great. Thank you, Sanam. No, WYNDS, we're not going to do that. Yes, comrade, it's us. Okay, I don't know where that's coming from. Is WINDS? No, we're not going to do that, like I said. And I would appreciate it if you don't make comments like this, mate. Cornay, why is retirement for women 60? It must be the same as men 63. Sanam, retirement for women is not 60 and for men 63. Whoever told you that is incorrect. Retirement for people is the same. So in South Africa, the earliest retirement age, okay, the earliest retirement age that you can go into retirement is 55, okay? It's the earliest you can go into retirement. Oldest age, there is no more oldest age. You can choose, if you don't want to retire early, any age, 60, 70, 80, 90, you can retire. When it comes to companies, and I'm talking private companies as well as government institutions, there is set dates for certain companies and set dates for certain, government institutions, set ages, okay? So in certain government institutions, you can retire at the age of 60, others at 63, others 65. Private companies, exactly the same. That is the rules for that specific institution you're working for, be that a private company or be at a government institution. That's their rules. But you don't have to go on the date that they say you have to go. You can go earlier. Like we've been discussing with GPF, you then get penalized if you go earlier, but you can go earlier. What you cannot do is you can't go later. If it is written into the laws of the company that their retirement age is 63 for argument's sake, then it's 63. The company can keep you employed after the age of 63, But then they have to contract you on a private basis and you can't belong to their pension fund anymore. So that's how it works. But there is no thing that says women are 60 and men are 63. We are all equal when it comes to the law, especially when it comes to things like pension and retirement. If we want equal opportunity, we must work equally hard. Am I correct? I agree with you, Sanam. And once again, just as I explained now, that is why there is no difference between retirement ages for men and women. I do know and I do agree that there is still some occupations out there where men are paid higher than what women are paid. And I do not agree with it. Because I feel that if we both walk into a company and we both go and work as an inquiries clerk, we should earn the same amount of money because we're doing the same amount of work. But, this is a but, there are jobs, okay, there are jobs where men earn better than women for other reasons. Now, just to give you an idea, rugby, for example. Our rugby players, our male rugby players, they earn a higher income than what female rugby players are earning. And it's not like they train hard or anything like that, but they do play harder. Let's face facts, men play harder than women. But the fact of the matter is that type of occupation and the income that you generate is based on public consumption and public need. So when you look at rugby, for example, you have 10 million people that will watch men's rugby, and therefore there's much more advertising that can be done. The channels, DSTV and whatever that can offer this, they can pay more to the advertisers. More people is going to see it, so more sponsors will throw more money at it. There's a whole range of reasons why the male rugby will get more viewers, and because they get more viewers, they will get a higher income because there is a bigger need for it. There's a bigger appetite for them. The same female rugby players, they won't get the same because they won't have 10 million viewers. They will only have 2 million viewers. And because they only have 2 million viewers, there's not so many sponsors, there's not so many advertisers, they don't get the same amount of screen time because the appetite for that, their rugby is not so big. So, are the two rugby players playing equally hard? I believe so. I believe women playing against each other, the impact that they have on each other when they play is proportionately the same as the impact that men have on each other when they play. But the men have a bigger following and a bigger appetite, and therefore they get the bigger income and the bigger salary. So, it's always a very contentious issue when it comes to should everybody work equally hard and get equal income. Because there are certain occupations, like I say, where it's absolutely true, but then there are certain occupations where it's not. And as I've given the illustration of men earning better in rugby, for example, there are occupations also where women will be earning more than men again, because there's a bigger need for them again in that specific line of jobs. Okay, so let's move back because that's not financial advice, it's just an opinion. Okay, could you explain what decides how much dividends pay? So Blitz, I can't give you the exact economical and theoretical explanation about that. But what I can tell you is dividends is basically like profit. So if a company is listed on the Joburg Stock Exchange, for example, their financials are done and their profits are determined at the end of the year, and basically those profits are then distributed to the shareholders as dividends. And that's a very plain, simple explanation of dividends and how it's paid out. It's a much more complicated calculation than what I've just explained, but that is the, let's call it the basis, or the basics on how it works. HTL Zar says, looking for a short investment period of 2 years with 4 bar to invest. Any advice? Mate, that 2 years investment term, it's a difficult one, especially with 4-bar. You see, the thing is, if you invested in the bank, which is more, if you put it into an investment with the bank, and I'm talking about a money market account, a 30-day call account, something like that, it is the better option because your 4-bar, you basically know what your return on investment is going to be. You are not concerned about markets moving up and down. So you've got a certain amount of guarantee. Yes, the problem with regard to that is you're going to earn substantial amount of interest, and because you earn a substantial amount of interest, you will most probably pay a substantial amount of tax. But if you make use of a different investment, okay, be that unit trust or an endowment, the problem with something like that is there's a cost factor. With the bank, when you put your 4 million rand into the savings account of the bank, if the bank says to you, I'm going to give you 8% return on investment, 8% on interest, the bank already knows they're going to earn 11% return on their investment. So that difference between the 8 and 11, that 3% difference, that's what they put in their pockets. That's their profits they put in their pockets. With the insurer that you do the unit trust or the endowment with them it's a bit different. They say, listen, I'm going to invest your money, and whatever return I get, that's what I'm going to give you. But there's a cost to this. There's an admin fee and a management fee and whatever the case might be, and I take my cost up front. So if you put your 4 million rand in, they already take their cost. Okay, and when they take their cost, your 4 million is not 4 million anymore. Let's say it's 3,950,000 rand after cost. Okay, now you first have to grow back that 50,000 rand, and then only does your 4 million start earning growth. And so you've only got 3,950, and it grows to 4 million, and after that you only start seeing the growth on your 4 million. So they take their cost up front. The difference is that if you now earn 11% return on your investment with that investor, that's what they put on your investment. So you might get 8%, the 10%, 12%, whatever the case might be, but whatever the return is, that's what you're going to get. The only problem is for somebody investing the 4 million for 2 years with the investment company, because of the upfront cost factor, it's very difficult to grow that money back quick enough to compete, so to speak, with what you would have gotten from the bank. And especially because you most probably going to make use of a portfolio that is in some way market related. If the market takes a bit of a dip in this 2-year period, then you've got a problem. So if you choose an investment where the market does not have such a big influence like a stable or balanced fund, then once again, you're back to an 8 or 9% return on investment, same as what you would get at the bank. This time you would get it after cost, this time you will get it after tax, the 8 or 9%, but you still have that problem of the upfront cost that it eliminates that growth. So it's very difficult to tell somebody straightforward, listen here, put it here, put it there. I think it very much depends on you as the investor and in how much risk you are actually willing to take. And understanding the concept, and I think the only way to understand the concept is for somebody actually sits and they sit and do calculations with you. To understand the cost differences, the impact of the risk associated with the two investments, and then to decide, listen, can I or can I not? So HTL ZAR, I know that I've now given you a bit of a long explanation, and it's not a straightforward answer, but I hope you understand from what I have explained why it is virtually impossible to give you a straightforward answer with regards to how and where. Shortest answer, the bank is most probably the best option. Oops, and now I've skipped a bunch again. Hang on, folks. Hang on it. Do you have any information about GPF? Yes, I do many videos on GPF. It's driving me nuts. And you will see that here, Mr. Rowan Carolus, they say I can invite him. Now, Rowan is one of my advisors. He sits in the Cape Province. And as much as I know quite a bit about GPF, Rowan is a real specialist. And Rowan on Thursday evenings normally has similar presentations than mine, where he tells people more about the GPF and can give you, I almost want to say, more enlightened and more educated answers on the GPF. So if you want to tune into or start following Rowan on TikTok and tune into his channel, he's definitely going to give you more precise information. But yes, I've got information on GPF and I try and keep myself updated. Cosmos Kind says, public service highest age is 65 in terms of Public Service Act. No gender disparity. Thank you, Cosmos Kind. You have basically confirmed what I tried to tell the person Nana, so I appreciate it. Thank you so very much. Khanya Naleri, I hope I pronounced it right, says, good evening, my very respected host and his guest of honor. Wow, that makes me feel super. Thank you. Webster says, hi, Corey. Is the economy better in Krugersdorp, Alberton? Must consider a shift in workplace. Webster, sorry. I think you're serious with the question that you're asking, but I had to chuckle. Webster, I honestly don't think it matters where you sit anymore. We are living in a new world where the economy is not restricted to a specific area. Majority of companies are doing business across the world and across South Africa. I live in Krugersdorp. I stay here. I've always worked here. But quite frankly, if I wish to move down to Cape Town or PE or Durban tomorrow, I can do it. With the power of the internet and Google meetings and things like this, I can virtually work from anywhere in South Africa. So I think what type of work you do is the determining factor. And I honestly don't know about whether the economy would be better in Krugersdorp or Alberton, because I think that you might have some industry in Alberton that you don't have in Krugersdorp and vice versa. Or you have more of one industry in Alberton than what you have in Krugersdorp or vice versa. So where you're going to live and work is very much going to depend on what you do and then on how you gear yourself to become a more national or international asset for companies. That's how if you don't work for yourself. Tax-free investment maturity is only 5 years. Only beyond that, what will happen? Tax-free investment maturity is only 5 years. Only beyond that, what will happen? Okay, so tax-free investments does not have a time period to it, okay? Tax-free investments, you can do for as long as you want. That's the one part about tax-free investments which I do not agree about, is that you can literally put money into a tax-free investment this month and draw it next month. There is no time period attached to it. Tax-free investments, however, works best if you leave it for a long time. And when I say a long time, 40 years, 50 years, 60 years. So if you can do a tax-free investment for your child and they can leave it until they retire one day, that's who is going to score, that child with that long investment period. But no, there's no maturity value, which is sad because people don't understand the workings of it and then keep on drawing the money. M says, Zimbabwe pensions ended up losing all its value in terms of farm seizures. Will it happen to South Africa? I know that's what happened in Zimbabwe. Will it happen in South Africa? Nothing is impossible. It could happen in America. It could happen in Switzerland. It could happen in Australia. It could literally happen anywhere in the world. South Africa is not unique, and I do not have a crystal ball. I don't know what the future is going to bring. The one thing I do know is, as much as people keep on worrying about this, our constitution is a great constitution that was done in 1994 when the ANC came into power. They have had numerous chances to change the constitution and implement stuff like this. It has not happened. The ANC has lost ground in the political arena, and therefore it won't be that easy to do it anymore. Seizing property without compensation is a bit of a fallacy in South Africa. Don't shoot me. I know you're going to think I'm talking nonsense, but the fact of the matter is it's not that easy. There's a whole lot of rules and stuff before anything can be seized. And a lot of farms in South Africa that has been taken over by government the farmers have been paid well. They have been compensated well. And I know of a number of farms where the farmers actually got more than they would have gotten if they sold it in the open market. So, treading very, very carefully here on what we talk about now. I don't know if it will happen in South Africa, but I believe it won't. That's my honest belief. I don't believe it will happen. Okay, let's move on. If I get 2 million rand from a pension, 1/3 is worth keeping in deposit bank and earn 6%. If you get 2 million rand from a pension fund and you put it into a deposit in the bank, I think you are making the biggest mistake of your life. Yes, I will say put 200,000 or 300,000 rand in the bank and leave it there. That's your emergency funds that you rush to if you've got a big problem. But the rest of that money will be much better off if you invest it into an endowment or a guaranteed income or depending on what your needs is. 6% in the bank, folks. Inflation in South Africa, once again, don't shoot the messenger. Inflation in South Africa is 3.8%. That is the inflation figure we get. Okay, now I know that true inflation is higher than that. I would say true inflation is closer to 5 or 6%. So if you do put money in the bank at 6%, you are just getting what inflation is giving you. So effectively, your money is not growing. Your money is standing still. And that effectively means that you are actually growing poorer. Because just try and understand this, if inflation is 10%, you get 6% return on investment. You see your capital amount increasing. But because the inflation rate is higher, you can buy less and less and less of the same amount of money. Therefore, you are actually growing negatively. You are actually growing poorer if your investment and the return on your investment is lower than inflation or equal to inflation. So, no, I will definitely not put my money, if I get something like this from a pension fund, in the bank. There is plenty of other investments that will be substantially better. Joey Bochella, does 32 notice accounts ideal for one who wants to renovate a house in the future? Joey, I suppose it could be. I cannot tell you because I'm not really a banker, okay? I've got a fair idea of how savings accounts work, a 32-day notice accounts and so on. Now, having done a few renovations over my life on my house, a 32-day call account is not a bad idea. Especially if you know when you have to start putting down the deposits. And I suppose if you are saving up the money and you're only going to start working on the house 12 months or 16 months down the line, then maybe it's a good idea because you're most probably going to get a better interest rate than what you will get in a normal savings account. So, yes, I suppose it's not a bad idea. I can't tell you how great or how brilliant it will be. I think in order for you to make use of such a savings account for the renovations of your house into the future, you must actually speak to the bank and find out about their different savings accounts that they have. Let them explain to you what the different savings accounts is, what the interest rates is that you can earn, etc., etc. And once you've done that, okay, once you've done those calculations and you understand the products that the bank offer, then at that stage you can actually make a decision as to which account will work best for you. Game On says, paying retirement from 2019, what will be the disadvantages if I decide to withdraw 30,000 Rand? Okay, so Game On, here's the question. How much are you contributing towards your retirement annuity? Okay, Let's imagine for 1 second that you are actually contributing towards your retirement annuity 30,000 Rand a year. Okay, over a 6-year period, you've then contributed 180,000 Rand. And forget about growth and all of that stuff. If you draw 30,000 Rand, you draw 1 year of your own contributions. So suddenly you've got 1 year less in contributions and growth going into the future. Now, in order to make sure that you still reach your targets at the actual retirement age, you need to catch up with that again. Now, you're not going to have to save another 30,000 Rand to catch up. You're going to have to save 40 or 50,000 Rand to catch up that 30,000 Rand, because you've already had 6 years of growth on it. You have to catch that capital up as well as the growth. So now, drawing 30,000 Rand from a pension fund, I think, is the worst thing that the person can do. You are using money that you need in retirement. You're losing out on the growth that you would have gotten on this. You will most probably never go and contribute extra again to catch up with what you have drawn. And then, of course, the big bugbear for me, you pay tax on that 30,000 Rand. So, if your tax rate is 30%, you pay 10,000 Rand of the 30,000 Rand to the tax man. So now you've lost the money, you've lost the growth, and you still lose more money because you pay the tax man. It's the worst thing anybody can do. And let's not go into the two-pot system, because I get on my soapbox and I get completely irritated and irrational. But no, don't draw money. There is only negative results. Only negative results. Lizzie, what is the requirement of qualifying as a financial advisor? So, to qualify as a financial advisor, there's different stages. A financial advisor that just wants to do funeral benefits only needs, I think, grade 10, standard 8, and the NQF4 qualification. To be a full-on financial advisor, you have to have what they call an NQF5, 120 credits qualification, which is a qualification you can do through various organizations. Or you have to have a financial diploma, you have to have a degree. So it's quite a substantial, quite a high qualification. It's not just matric, it's higher than matric. That's the first thing. And then you have to do the RE5 exam. And the RE5 exam is where you write an exam on the FSCA. That's the organization that looks all over the financial services industry. You have to write an exam on the law, the legislation that they have put in place. So those are the two things. RE5 qualification, 120 credits on NQF level 5. And then once you have done these things, or while you are doing these things, you have to work under supervision for 2 years. In that period, obviously, you have a supervisor that has to teach you, help you, train you, make sure that you learn the ropes, etc., etc. And that is the basic qualifications. Game On says, oh, I mean 2009. Game On, I'm still adamant that 30,000, I don't care if you draw 3,000 Rand or 30,000 Rand. You are losing out. You're losing tax. So your 30,000 Rand is not going to be 30,000 Rand. You're losing that 30,000 Rand that has the ability to grow until your actual retirement age. Go and think about it like this. Go and take 30,000 Rand. Go and write it down on a piece of paper, okay? And then you work out what is 9% of 30,000 Rand. Okay. So 9% is going to be just less than 3,000 Rand. Okay. You add that figure to the 30,000 Rand, and then you add another 9%, and you keep on doing that. So if you're 40 years old now, just as an example, and let's say you want to retire at the age of 60, you go and do that little calculation all the way to the age of 60, and then you see that 30,000 Rand at just 9% per annum, how much it would be worth at the age of 60. And then you get a real indication of how much you're losing. What is this? I see on top here it says 4 and 3. It looks like I've got people joining me and so on. It's weird. But anyway, guys. Oopsie, there goes it again. it jumps, and then I have to scroll back and find you guys again. Okay, Nabil says, is investment unit trust better than investing with any insurance company for 5 years? Nabil, that very much depends on two things. It depends on your personal tax rate, and it depends on the type of unit trust you're going to take. So in terms of personal tax rate, if your income that you earn puts you in a tax bracket that's higher than 30%, okay, then the unit trust is not such a good idea, because when you get your funds one day, when you get your maturity value, if you withdraw the money after 5 years, all the growth that you have earned is taxable via capital gains tax. And I don't know how to explain this, but capital gains tax is linked to your personal tax rate. So if you are on a 40% tax rate, your formula is worked on a 40% personal tax bracket, your capital gains is taxed accordingly. So that means that your capital gain is taxed at 40% capital gains tax. Where if it was in an endowment, even though you are on a 40% tax bracket, in the endowment, the tax rate in there is 30%. So by having an endowment, you would already score 10%. Now, if you do a unit trust, because your tax rate is, say, a 25% tax rate, well, then the unit trust is the better option, because you're now getting capital gains tax at a low rate. But, and here's the but, if you are on 25% now, and when it matures 5 years from now, you have had increases in salary, and you are now on a 36% tax rate, you're getting taxed at 36%. So even with unit trust, it's sometimes a bit difficult to tell people whether it's a good or a bad idea, because we don't know by how much your income is going to increase. The second thing is, with regards to, is it better on a unit trust, investing it for 5 years? It depends on that unit trust that you buy. If you buy a, what you would call, let's use a Allan Gray equity fund, okay? So on an Allan Gray equity fund, you can use it in both an endowment, and you can use it in a unit trust, or as a unit trust. So you get the same return on investment on that equity fund, because it's one fund. But in the endowment, it's taxed at the 30%, like I said. And in the unit trust, the capital gains tax is going to be in your pocket, in your name, when the maturity comes, at what your tax rate is. So if your tax rate is higher than 30%, and you had it in unit trust, the endowment would have been better, and vice versa. So unit trust is a great investment for liquidity, because the money is available, etc., etc. You can even manage the capital gains tax out of it, so to speak, by not withdrawing everything in one go, and managing the withdrawals so that you get your 40,000 rebate every year. So there's ways and means to make sure that you don't pay as much capital gains tax. But whether it is better for you to take a unit trust than an endowment or something else, man, it's virtually impossible to say without doing a planning session for you. And you know, this is the weird thing. When I started doing this videos and everything, and I started giving advice, I was hoping that I would be able to educate people. I never realized how many people, or how many questions there was going to be like this one, where people ask, is this better or that better, whatever, that I can't really give a straightforward answer, because the answer is dependent on the person's circumstances. And the only way to tell a person whether it is or is not is to understand and know the circumstances. Any case, I hope that helps a bit, Nabil. T-Man's joint. Oh my goodness gracious. T-Man, maybe you must get another name. Is Allan Gray Balanced Fund and Coronation Balanced Fund have similar exposures? Pretty much, yes. They do not invest in exactly the same shares, bonds, cash, etc., etc. But, and the reason why it's similar, and you can go and look at all balanced funds. This is not just Allan Gray and Coronation. Old Mutual, Sanlam, Marriott, 91, all of them. The thing is with a balanced fund, by law, when a balanced fund is created, you have to tell the registrar, I'm going to have this balanced fund, And the registrar says, okay, if you want to do a balance fund, here's the rules. The rules is you can only have, let's call it between 65 and 75% in shares. Then you must have between 10% and 15% in property. And you must have 15% to 20% in cash, whatever the case might be. So the portfolio manager can buy and sell more shares as they see fit, but they can't have more than that maximum of, let's say, 75% in shares in the portfolio that the registrar allows. So in terms of what we can invest in as portfolio managers, we're limited by the rules. Okay? In terms of what shares is going to be bought, well, that will differ from company to company, because Old Mutual might decide they like Coca-Cola, and Alan Gray might decide that they like Nestle, and this guy likes that, and they will buy shares based on their portfolio managers and what they feel. So the balance funds have similar exposures indeed, but they don't have the same shares. Okay. Oh, there's Rowan saying to me, Correa, I start at 7 o'clock. Thank you, Rowan. Thank you very much. So anybody, GPF, if you want to talk GPF, look at this. Rowan, R-O-W-E-N, Carolus, C-A-R-O-L-U-S. Go and find him on TikTok. Trust me, you will not be disappointed if you've got questions on GPF. Rowan is a real specialist. He knows stuff that I wish I know. I have to ask him every now and again. Thanks, Rowan. Pleasure, Webster. Hey, Mr. Gijs Kok, I haven't seen you in ages. Glad to see that you've come past tonight. Game on, 1,500. Yeah, okay. Oh, okay, we're still on that question. Can't say, China. Mr. Philip Estreisen, good evening. Nice seeing you again. Game on, it's only a pleasure, Mama. It's only a pleasure. I hope I didn't come down like a ton of bricks on you, but feel my heart. Feel my heart. I really don't want people to lose money if it's not necessary. And I do understand if people want to make a withdrawal from the two-part system. I think we all are always tempted, but you must really be in big trouble before you do that. And then I would still go and look for other options before I look there. Yes, it's called an RE5, in Amandla 106. It is called RE5, Regulatory Examination 5. And then if you want to become a key individual, a KI, so if you want to start your own brokerage and you want to become a key individual, then you must not only write the RE5 exam, you must also write the RE1 exam. Regulatory Examination 5 and 1. Wealth Management Certificate. Yes, sir. That is one of the things that you can go and do is a Wealth Management Certificate. You can do your CFP, you can do a financial degree, financial diploma. There's really a lot of qualifications that you can go and do. BE, I'm not sure what you are referring to. It is the worst thing, but ignoring how it can help you is not good either. Sorry, I don't know if I missed the previous comment, but I'm not sure what you are referring to here, BE. How do you get into an endowment? Okay, so how you get into an endowment, you must actually apply to the company. You must submit application documentation in order to take up an endowment with the company. And you can do that by speaking to a financial advisor who can give you assistance and help you. Brokers, there's certain brokers who are called intermediaries, and all they do is they literally give you the product. They don't give advice. You can even phone the company and do it through them, and then you will be given a broker, a desk broker as we call them, somebody that literally sits at their desk, has got certain qualifications in order to be financial advisors, but they don't act as financial advisors, so they don't give advice. They just sit there and they just do what the client asks. So that's how you get an endowment. You can't, however, apply, as far as I know, without some human interaction. Oh, lovely. Here we go again. What's the best investment? I'm putting money into an RA. I gave quite a long explanation on this earlier, so I suppose you weren't on the call, where I said it's impossible to tell people what is the best investment unless I understand your personal circumstances. Only if I understand your personal circumstances and what your needs are, then only can I tell you what is the best investment according to me for you. Folks, we attend these seminars and stuff on a regular basis to keep ourselves educated. And I was one a few years ago where they compared endowment, unit trust, tax-free investment, and a retirement annuity over a long period of time. I can't even remember whether it was 30 or 40 years, but it was a substantial amount of time. And basically all four investments pretty much gave the same return on investment. They were not exactly the same, but very close to each other. What it did show is that if you invest for a very long period of time, your tax-free plan, your retirement annuity will be the most beneficial. Then as the time frame gets shorter, so if you're not investing for 40 years, but you're now only investing for 10 years or 15 years, then the figures show that now it becomes better to have an endowment or unit trust. So it does, the term that you're going to be invested in definitely also has an impact. But I think the important thing for me that came out of that was if you looked at how close the return on the four different investments were over the different time periods, from literally 5 years all the way up to 40 years. There was always a little bit of a difference between them, but not big. It was not like, wow, okay, I need to do a retirement annuity because this thing is going to kill everything else. It's like 40% better return. Okay? So I think try and understand that. Investments all are good. It's just that some are better for some people. The returns on the investments are going to be pretty much in line, but a retirement annuity is going to be better for the person that wants to have more tax rebates and get a discount on his taxes. A tax-free investment is going to be better for the person that already has the maximum tax rebates, but now still wants further tax benefits. An endowment is going to be better for the person who is in a 30% or higher tax bracket, and he wants to have an after-tax or tax-free return on his investment somewhere in the future. A unit trust is going to be better for the person that wants liquidity, always have access to his funds, and preferably is in a tax bracket of less than 30%. So each of these investments have different benefits, which determines who they will fit best to. In terms of the actual returns, like I said, it's pretty much close to each other. But yeah, if you want to get very, very technical about it, the longer the investment term, tax-free retirement annuity, the shorter the investment term, endowments, unit trust becomes the better ones. Kunta says, encourage more viewers. Oh, sorry, that's not what I wanted to read. Okay, 5 more minutes. Since the news about $1 million should be... Since the news about $1 should equal 7 Rand, I suppose 17 Rand is what you're saying, yeah? How would you take advantage of it? People are already taking advantage of it. People that are investing in global equity funds, okay? Their funds are not doing so well at the moment because at some stage, the Rand-dollar exchange rate was like 22 Rand to the dollar. So now, because the Rand is strengthened against the dollar, they're not getting such good returns because the Rand is working against them. But when the Rand turns around, and it will turn around at some stage, and let's say it goes back to 20 Rand to the dollar, that 3 Rand difference would already see that your investment is shooting sky high. So how to take advantage of it? Is to make sure that you have a diversified investment portfolio. Have some money invested internationally, have some money invested locally. I mean, the stock exchange in South Africa is doing great, so the funds are doing fantastic. And invest consistently, all the time. Get that rand, what do they call it, rand cost averaging to work for you. That is how you take advantage of it. But yes, anybody that has lump sums at this stage and that does international investments, understanding how the international investments work, and especially making use of asset swap investments, they will most probably benefit most once the rand starts making a bit of a U-turn. Okay, oops. Oh my goodness. Folks, I'm not going to get through everything like every Thursday night. Next Thursday, I'll be back. You've got my WhatsApp number in the profile. You're welcome to send me messages there. I promise I will answer. So let's do a quick fire to try and get through the rest of the questions. Hello says, good evening, Corneille. You have spoken to why does tax increase not increase the SARS threshold? Mate, that's something that you have to discuss with SARS. SARS makes their decisions based on their financial based on the government's financial decisions. So I can't tell you why SARS does not increase their thresholds. The income tax thresholds is adjusted every year. I have not come across one year where they have not adjusted that. But yes, the thresholds with regards to things such as rebates, rebates on tax, rebates on capital gains tax, the 550,000 tax free, that does not get checked or what's the word? Rehearsed. Now I've forgotten the English word. My English is finished for the day. That does not get checked and rehashed on a yearly basis. But the only thing to do there is to write to SARS or the government and ask them, honestly. New listing or now? I have no idea what you're saying. Why is SARS threshold limited to 23,800? That's what they decided on a few years ago. There must be a calculation that they've done that said, okay, this is what we're willing to give people as a rebate. Then I need to try and get this in specifically. There we go. Okay, our education system failures, hence the questions regarding taxes, investments, wills and estates. I understand my GG, and that's where I try and educate people as much as possible. But a lot of the stuff, even I don't know the answers because I'm an expert on financial advice. I've got a good understanding and knowledge of how taxes on investments work. Because I've been working with this, I've got a good understanding on wills and estates. But if you need to have more specialized information on taxes, I have to introduce you to my accountant, who I've known for the last 30 years and is spot on with what he gives me. If you need to know more about wills and estates, I have to introduce you to the lawyer that I've been working with for the last 30 years, because his knowledge on wills and estates and trust is 100 times better than mine. And so it's almost impossible for one person to be all knowledgeable, so to speak, on all of these aspects. So I try my best to give people information on investments, and with my limited knowledge in regards to taxes and wills and estates, I tell you what I can about that. So I understand what you're saying with regards to our education system, but remember, there's nothing that stops you to go and teach yourself. Plenty of information, free, gratis, or for nothing on the internet. Aside from RO, where's the best tax efficient product, local or offshore in the market in your view? Duncan, I've answered this a couple of times, but tax-free plans are brilliant. Endowments are brilliant. It all depends on what your personal tax rate is. So if you have an RA, then look at a tax-free investment. If you've got a tax-free investment, look at an endowment. As a matter of fact, I'm not the biggest tax-free fan, so I would just say go to an endowment. And on all these products, you get products that's got exposure to offshore. For a company, trust, and individual, on all three of those, exactly what I've told you now, except that in a trust and a company, You can't do the retirement annuity because you have to do it for an individual. You can only do in unit trusts and endowments for trusted companies if it's a corporate institution like that. If it's an individual, you can do a retirement annuity. What's the best unit trust? That's like asking me what's a piece of string. Well, in South Africa, there's 300 companies that offers unit trust, and there's more than 1,800 unit trusts. If I knew which unit trust is going to be the best, I would be a multimillionaire and definitely not sitting here. Don't know. It's impossible to say because every year a different unit trust does better than the previous year. It's best unit trust. Okay. Tax-free threshold must fall. Make 2 million. Bye-bye, Philip. Keep well. I highly appreciate you taking your own time and education. My pleasure, Mum Gigi. Ladies and gentlemen, amazingly with the quickfire questions, I have managed to answer everybody. Have a wonderful evening. Go and have a fantastic weekend. And then next week, Thursday, I'll be right here talking to you again, answering questions. So yeah, have a fantastic time. God bless. All the best. Keep well. Bye-bye.